Hey everyone, welcome back to the channel. Today we're talking about something that could affect nearly every working family in America, the 2026 tax changes. These changes are coming soon, and they could mean smaller paychecks, higher tax bills, and fewer deductions for millions of households. The reason? Many of the tax cuts passed in 2017 under the Tax Cuts and Jobs Act, TCJA, are set to expire at the end of 2025. So, if you're a working parent, homeowner, or small business owner, here's what you need to know before the clock runs out. Let's start with what's actually happening. The Tax Cuts and Jobs Act lowered taxes for individuals and families starting in 2018. It reduced income tax rates, doubled the standard deduction, and expanded the child tax credit. But here's the catch: most of those benefits were temporary. Unless Congress acts, those cuts will automatically expire on January 1st, 2026. That means the old higher tax brackets and smaller deductions will return. Millions of working families who've enjoyed lower taxes for nearly a decade could suddenly find themselves paying more to the IRS. The first major change is higher tax brackets. Right now, the lowest rates are 10%, 12%, 22%, 24%, 32%, 35%, and 37%. When the TCJA expires, those will revert to pre-2017 levels, topping out at 39.6%. For working families earning between $50,000 and $200,000, that could mean paying hundreds or even thousands more each year. The IRS won't raise taxes. The law will just revert to what it was before. So even if your income doesn't change, your tax rate probably will. Next, let's talk about the standard deduction, which has made filing taxes easier for millions of families. The TCJA nearly doubled it. In 2025, it's $29,200 for married couples and $14,600 for individuals. But in 2026, that deduction will drop back to roughly half. That means more of your income will be taxable again. Families who've been taking the standard deduction will see smaller refunds or even owe money at filing time. This change alone could cost working families thousands over the next few years. Another big shift involves the personal exemption. Before 2017, taxpayers could deduct a set amount for themselves and each dependent. That exemption was eliminated in exchange for a higher standard deduction. When the old system returns, the exemption will come back, but the standard deduction will shrink. For families with children, this might balance out a bit. However, for couples without kids or single parents, it could still mean a higher overall tax bill, especially when combined with other expiring credits. The child tax credit, CTC, is another major area where working families will feel the impact. Right now, parents can claim up to $2,000 per child under 17, and higher income families qualify for part of it. When the TCJA expires, that credit will drop back to $1,000 per child, and fewer families will qualify. That means families with 2 or 3 kids could lose thousands in tax relief. The CTC has been one of the most popular and effective ways to support working parents, but that extra help is set to shrink dramatically. Another important change affects married couples. The TCJA eliminated the so-called marriage penalty for most taxpayers by aligning joint filing brackets with double the single filer brackets. But when those provisions expire, the marriage penalty returns. That means 2 people earning similar incomes may pay more in taxes after getting married. For dual-income families, that could result in hundreds or even thousands of extra dollars owed each year, simply because of how their combined income is taxed. Let's not forget about itemized deductions. The TCJA capped the state and local tax SALT deduction at $10,000. That cap is set to expire in 2026, which could benefit homeowners in high-tax states like California, New York, or New Jersey. However, since the standard deduction will shrink, more people might start itemizing again, making tax filing more complicated. The mortgage interest deduction could also shift, raising the cap from $750,000 to $1 million, but the net benefit for most middle-class families will still be limited. Another area of concern is the alternative minimum tax, AMT. The 2017 tax reform raised AMT exemption levels, sparing most middle-class families from paying it. But once those provisions expire, more households, especially those with large deductions, could be pulled back into AMT territory. This tax was originally designed for the wealthy, but the thresholds don't always keep pace with inflation. Without the current exemptions, many upper-middle-class families could face surprise tax bills starting in 2026. For working parents, the loss of certain deductions will hit hard. Expenses like childcare, unreimbursed job costs, and moving expenses were limited or eliminated under the TCJA. Some of those may return, but not all. Unless new laws are passed, families will have fewer ways to offset the rising costs of raising children. And with inflation already squeezing budgets, even small changes in tax credits or deductions can make a big difference in a household's financial stability. Let's talk about the Earned Income Tax Credit, EITC, one of the most important benefits for low to moderate income working families. While it's not directly affected by the TCJA sunset, inflation and income thresholds could change how many people qualify and for how much. If tax brackets rise but EITC thresholds don't adjust accordingly, some families might lose eligibility or receive smaller refunds. This means even working-class Americans who rely on refundable credits could see their tax relief shrink in 2026. Small business owners and freelancers, many of whom are working parents, will also feel the impact. The 20% qualified business income, QBI deduction, is set to expire after 2025. This deduction has allowed millions of self-employed workers to reduce their taxable income, helping them save thousands each year. Without it, gig workers, contractors, and small business owners could face significantly higher taxes. If you run an Etsy shop, drive for Uber, or own a small business, it's time to start planning ahead. Another hidden effect involves inflation indexing. The TCJA switched to a slower inflation measure called chained CPI, meaning tax brackets move up more slowly each year. If this continues, working families could experience bracket creep, where raises meant to keep up with inflation actually push them into higher tax brackets. So even if your paycheck grows, you might end up paying more in taxes without feeling any richer. It's a subtle change, but one that can add up quickly over time. When you combine higher brackets, smaller credits, and fewer deductions, the result is clear. Working families will owe more to the IRS in 2026. The average middle-income household could see taxes increase by $2,500 to $3,000 annually. For some, that means a smaller refund. For others, it could mean cutting back on spending or savings. The changes don't just affect your tax bill. They could impact your monthly budget, childcare plans, and even retirement contributions. This is why early planning is essential. So what can families do right now? Start by reviewing your finances for 2025 and beyond. Talk to a tax advisor about how these changes could affect you. Consider increasing contributions to pre-tax accounts like 401ks or HSAs to reduce taxable income. Adjust your W-4 withholdings to avoid surprises in 2026. And if you're eligible for credits or deductions now, make sure you're fully using them before they expire. Proactive planning can help cushion the blow once the new rates kick in. Families should also look into long-term strategies like Roth IRAs, college savings plans, or dependent care accounts. While taxes might rise, smart planning can still help you keep more of your hard-earned money. Keep in mind that Congress could still extend some of these cuts, but with political divisions, nothing is guaranteed. It's better to prepare for higher taxes now and be pleasantly surprised later than to be caught off guard when filing your 2026 return. The bigger picture here is about fairness and stability. Supporters of the 2017 cuts say they boosted economic growth, but critics argue they mostly benefited corporations and high earners. The expiration of those cuts will hit working families hardest, creating new pressure for Congress to act. The debate will likely intensify as 2026 approaches. Will lawmakers extend the cuts, modify them, or let them expire completely? The answer could reshape the financial future of millions of middle-class families. In conclusion, the 2026 tax changes will bring higher rates, smaller deductions, and fewer credits, leaving working families with less take-home pay. But by planning now, you can reduce the impact and protect your financial future. Review your taxes, adjust your strategy, and stay informed. Whether Congress acts or not, preparation is your best defense. Thanks for watching. Don't forget to like, share, and subscribe for more updates on taxes, Social Security, and how to keep more of your money in your pocket.